I do very much appreciate the opportunity to speak to such a diverse and knowledgeable audience. What I'll be talking about today is a reflection of a study that I've been carrying out together with my research partner, Yan Hairong, who is an anthropologist at Hong Kong Polytechnic University. And she became interested in the subject of Chinese migration to Africa because she'd done work about migration within China. I was interested in the subject mostly from the point of view of the political discourse around the Chinese presence in Africa. So we teamed up and have been doing work about links between China and Africa now for more than 10 years. That means that we do field work in Africa. We've gone to perhaps a dozen countries, but we concentrate our field work now in Zambia, principally because of the copper mining industry there. And we've particularly concentrated on studying the activities of one Chinese copper mining company, the principal copper mining company, CNMC, which I'll talk about in some detail later on. The way that I'm going to do this presentation today is to first talk about Chinese mining in Africa in more general terms, a lot of statistics and all that. And then I will talk about a particular case, the very company that I just mentioned, CNMC, which was heavily critiqued in a report issued by Human Rights Watch at the end of 2011. And we, that is Yan Hairong and myself, responded to that Human Rights Watch report, which we thought had many problems attached to it. And I'll talk about some of the methodological problems, but also even the political problems attached to that report. And that report was about the activities of CNMC in Zambia. While we hold no particular brief for the company, nevertheless, we thought that what was being said about its activities were by and large empirically inaccurate, and we wanted to point that out through our critique. So I'll first say something about Chinese activity in the world in terms of investment, and then go on to talk about Chinese investment in Africa, and then go on to talk about Chinese mining in Africa. So this is just a quote from Carlos Lopez, who's from Guinea-Bissau in West Africa, and he is an economist who frequently has to respond to questions about Chinese investment in Africa, so this is one of the things he had to say fairly recently. So Chinese investment in the world, often one hears that China's buying up the whole world. It's a constant theme in Western media particularly. And not long ago, Peter Noland, well-known China-specialized economist at Cambridge, responded to this claim that China is buying up the world by publishing a book entitled "China's Buying Up the World?" and in which he showed that in fact China is a long way from buying up the world. Well, in terms of Chinese investment in the world, as you can see in 2014, the stock of outbound foreign direct investment in the world, if you look at it in terms of countries and in relationship to their GDP, the US is equal 36%. This is the stock of investment, 36% of US GDP. France was 45%, UK 54%, and China only 7%. Now, of course, China is a very major economy, so 7% of that very major economy could still be a lot. But if you look at this second set of figures, China's global OFDI in 2014, 730 billion, which sounds like a lot of money, but only 2.8% of the total of OFDI in the world, $26 trillion, which really is a lot of money. So China's share was actually less than that of the UK, less than that of France, and much less than that of the US. How about Chinese investment in Africa? The flow of FDI to Africa was 4.4% of the world's flow to the continent in 2014. And that was less than 5% of China's OFDI to the whole world. Now, if you look at the end of 2011, I actually don't have any more recent comparison, I'll be looking for one soon, but at the end of 2011, when the Chinese stock of OFDI in Africa was then 16 billion, it's now about 32 billion, but then it was 16 billion, and you can compare that to investment by the old colonialists, Britain and France in Africa, $58 billion for France, 48 billion for the UK, and for the US, also 58 billion, even though it wasn't an old colonialist in Africa, old colonialists in perhaps other parts of the world. Anyway, in 2014, the stock of Chinese investment in Africa was by and large held by state-owned enterprises, SOEs, from China. And only 10% of the stock of OFDI in Africa from China was held by private companies. But in terms of projects, most of the projects, more than 50%, were projects by privately owned companies. And this is increasingly the case in Africa. So the projects are smaller, they're less capital intensive, the projects from privately owned companies, but there are many more of them now than there are projects by state-owned enterprises. So state-owned enterprises are still basically concentrated in construction and mining. Privately owned enterprises are in manufacturing, trade, and logistics. The Chinese investment in Africa is highly concentrated in 8 states. Africa has 55 states. So these 8 states are some, of course, of the larger and more important states in Africa. No offense to Ghana, of course, in that regard, but it just happens that South Africa, Nigeria, Angola are just bigger places. Anyway, they draw more Chinese investment, so you can see the distribution of Chinese investments in those 8 states. In recent years, there's been a kind of shift away in terms of Chinese investment in Africa from basic infrastructure and mining to other types of investment, particularly to manufacturing. And as I mentioned before, manufacturing is basically the realm of privately owned enterprises. So of 156 studied Chinese greenfield investments in Africa between 2003 and 2014, more than half of the jobs were created in manufacturing. And that's the real coming field in terms of Chinese investment in Africa. So the stock of Chinese investment in Africa in 2013 was divided in the way indicated. As you can see, extractive industry, meaning of course basically oil and minerals, still 30% of the total. China is actually far from being the largest investor in mining in Africa. 75% of the world's mining companies are based in my motherland, Canada. 1,300 Canadian mining firms in the world. And in 2014, 133 Canadian companies had invested over $27 billion in mining assets in Africa. But they're topped by a little bit by another country's investments, Australia's. There were 236 Australian companies in 2014 to 2015 operating in Africa with a total investment of about $30 billion. Now that's the stock of investment of Australian companies in Africa. If you look at, going back to 2012, to committed and planned investment, of course lots of plans go awry, but if you look at that total, then it's over 50 billion US dollars. Well, at the end of 2013, total Chinese investment in Africa was about $26 billion. And 26% of that was in mining, so less than $7 billion US dollars invested by Chinese companies in mining in Africa. And that means that Chinese investment in African mining is roughly a fourth of the level of Canadian investment or Australian investment in mining in Africa. At the end of 2013, the stock of Chinese investment in mining in Africa amounted to less than 1% of China's overall outbound foreign direct investment in the world. So Chinese investment in mining in Africa is the archetypal investment of Chinese in the world for the Western media. They talk about it constantly as if it's very typical, but in fact it's less than 1%. And investment in mining in Africa by Chinese companies was less than 1/8 of the total of investment worldwide by Chinese companies in mining in the entire globe. So China's relatively low investment in mining in Africa also has to be seen in relationship to the Chinese mining industry as a whole, because China is a very significant mining country. China accounts for some 15% of the value of all of the minerals produced in the world, but most of Chinese mining is found, of course, in China itself. China is a country with 5 million mine workers. Now that sounds like an enormous number, but actually proportionate to the population, it's roughly the same as Australia. I'm not an expert on Australian mining, of course, but I think I've heard that there are about 100,000 or so mine workers in Australia. So, of course, compared to the population, roughly the same, which means that just as Australia has a profile of a mining country, China actually has a profile of a mining country as well. But very recently, in the last few months, the Chinese government announced that owing to overcapacity in both coal production and in the steel industry, it was going to sharply cut back on employment in both of those industries. Of course, with coal, part of that has to do with environmental concerns, because after all, China does have to meet its commitments in terms of climate change. But there is a great overcapacity in terms of coal production, which means that a lot of coal miners are going to be laid off, and maybe that'll save their lives. Chinese investment in mining in Africa is very diverse in terms of subsectors, bauxite, chrome, copper, iron ore, etc. And also fairly diverse in terms of countries in Africa. There are Chinese mining investments in at least 18 countries that I could count. And although it's diverse in terms of countries, there's a concentration in one country, and that's precisely the country that I'll be talking about today, Zambia, where about 1/3 of all the Chinese investment in mining in Africa is located. But the Chinese investment that's come to Africa came late. It really only began at the very end of the 1990s. Most of it is 21st century investment, and that means that the assets that Chinese mining companies have acquired in Africa have by and large been marginal assets. That is, they picked up a lot of mines which were under care and maintenance and restored those, and they haven't done much in the way of greenfield mining investment. Of course, those mines tend to be less profitable. There was a good reason why they were under care and maintenance, because their ore had played out by and large, and that meant that the Chinese companies had to get whatever they could by very hard effort. And this is just a map showing not only investment but also contracts levels in various African countries. And as you can see, that it's very highly disproportionate from one country to the next. If you look at investment in mining, it's this pale blue. So you can see what the proportions are. This is year by year, and this is, of course, the flow of investment. And you can see that the proportions are actually rather small compared to overall Chinese investment. And although this is labeled as selected Chinese infrastructure projects in Africa. You can see the countries where China has mining rights. Actually, China doesn't exist except as a geographical entity. It's Chinese companies, of course, which have acquired mining rights. But everybody in the West likes to talk about China doing this or that as if there were 1.4 billion Chinese acting in concert. So most of the Chinese companies that invest abroad, I'm not talking just about mining companies, but Chinese companies as a whole, most of them lose money. About 65% of Chinese companies that venture overseas end up losing money. The world standard is about 50%. So in part it's because of inexperience on the part of Chinese companies investing abroad. After all, they're the beginnings of going out, going out from China to invest abroad was really only around 2000, the year 2000. So not much experience. And then also Chinese companies tend to be greater risk takers in terms of where they invest. As I said before, they often have to pick up marginal assets, and it's harder to make a profit with such assets. So Chinese companies in mining, a lot of them actually have lost money, and I'll be giving you an example soon. But you can see this headline from a couple months ago from Forbes magazine, a major business magazine in the US. Going home, Chinese mining companies losing billions of dollars as they retreat. This is something that really just began last year. That is large-scale losses of money and the beginnings of some Chinese companies, Chinese mining companies, retreating from wherever they were outside of China and waiting it out, hoping that things will be better in the future. An example is the company that I talked about in terms of profitability. In 1998, CNMC, China Non-Ferrous Metal Mining Company, which is a state-owned, central government-owned level of SOE, it bought the first Chinese-owned mine in Africa. And this was the Chambishi mine, located in Zambia's Copperbelt. And this mine had been under care and maintenance for 13 years before it was reopened by the Chinese company. CNMC took about 3 years to get it back operational. Of course, the mine was long flooded and very difficult to restore. Needless to say, the company lost money initially. It lost a lot of money, actually. And it wasn't able to attain profitability until 2005. After that, it made about, on average, $35 million in profits per year between 2005 and 2011. I kind of lost track of the profitability figures for 2012 and 13, or maybe they just didn't care to reveal them to me. But in any case, in 2014, they actually did achieve a fairly significant profit level for that 1 year and made $140 million. But 2015, copper prices tanked, and that meant that they lost money big time. So last year, $100 million in losses before taxes, and they owe $90 million in taxes. So needless to say, overall, they haven't made money. Now, Chinese investment in mining in Africa is nevertheless going forward despite the low prices for commodities generally, and Chinese companies are engaging in counter-cyclical investment. They did quite a bit of this in 2008, 2009 during the global financial crisis. That is, they bought up some assets that were owned by other foreign investors, and they were able to get them relatively cheaply because those other foreign investors were, of course, retreating. So in the last year, Zijin, which is a fairly major mining company in China, bought up Ivanhoe Mines, and you can see some of the other purchases being made by Chinese companies in Africa just over the course of the last year, despite the fact that the prices of the various ores that they extract have gone down significantly. CNMC itself, building 2 major smelters, just across the border from Zambia in the Democratic Republic of Congo. And now there are some privately owned Chinese mining companies operating in Africa as well. Just seeing the beginnings of that. Well, Chinese companies, mining companies, were once seen very much as strangers in the eyes of Africans. That is, Africans were not very familiar with Chinese in general, and particularly Chinese operating in the mining industry. But I'd say that over the course of the last few years, that situation has become more normalized. That is, more and more Africans have become familiar with Chinese operating in the mining industry. And they're seen more as normal foreign investors. And the companies themselves have joined chambers of mines. They increasingly operate in the same way as other foreign mining companies do in terms of labor relations, environmental practices, CSR, etc. I'm not saying that's good, I'm just saying that's how they operate. Chinese mining firms nevertheless do have some distinct features, and those distinct features can be seen in part from the debate that I will now talk about in terms of Chinese mining investment in Zambia. So as I said at the outset, what I'll talk about with regard to Chinese mining investment in Zambia is basically the response that my partner and I made to the report issued by Human Rights Watch, which is of course a major human rights NGO headquartered in New York, to the study that they had carried out about Chinese state-owned enterprise investment in mining, copper mining in Zambia. And this of course was a report about the company that we happen to study, CNMC. So I'll put this in the context of the claims that are sometimes made in discourses about who is bad and who is good in the world in this or that. One context that is somewhat analogous is the discussion during the European financial crisis of the practice of various states within Europe. That is, the media in the world and politicians in Northern Europe in particular basically divided Europe into those countries which were good and those countries which are bad in terms of their financial practices. So Greece was singled out during that time, which is a couple years ago, as the real bad country of the European Union in terms of its financial practices. So the Northern European politicians and the media in Northern Europe, Germany, France, Scandinavian countries, etc., portrayed the Greeks as people who were tax evaders. The Greek government was supposed to be anti-business, the Greek workers were lazy, there was a lot of corruption in Greece, etc. Then along came a scholar from Harvard, Richard Parker, and did a study to determine whether or not his claims that the Greeks are the worst in Europe were true or not. And his conclusion was that what was being said in the media about Greece was by and large a set of moralizing cliches, as he put it, and they're just empirically inaccurate. So he looked at matters like taxes in Greece, and he found that they were about 1/3 of GDP, which is the European average, and that Greece has more small entrepreneurs than any other country in Europe, that the Greek government workforce was proportionate to that of other European countries, and that corruption in Greece, while it certainly exists, was not generalized, but was highly concentrated in the health sector. In other words, if you get sick, you have to bribe doctors. But there was no general corruption throughout Greek society. So also this discourse said that it wasn't just Greece that was bad. Greece was the worst, but there were all the southern European countries were bad in one respect or another. So Portugal, Spain, Italy, etc. So Europe was in effect being divided into Northern Europe, which was quite proper in the way it approached financial dealings. And then there were the profligate Southern European countries. So the Northern Europeans represented themselves to the world as being virtuous, the Southerners as being very problematic. Of course, within Europe at that time, going back a few years, there was a division between the European countries which were run by center-right parties. Those were mostly in Northern Europe. And the Southern European countries were run by center-left parties. There wasn't actually a huge amount of political difference between all these parties, but they could be divided up that way. So, in effect, the critique of Greece was also a critique by the center-rightists of the center-leftists. And then one has to factor in racism. And indeed, it exists even as to Southern Europeans. An example could be seen in an article in Der Spiegel, which is a major news weekly in Germany, in which they commented about how this Italian cruise liner had to run aground, and the only reason why it did so was that it had a Southern European captain, Italian. So we approached the critique of this Human Rights Watch report in the same spirit as Professor Parker approached the critique of Greece. That is, we wanted to employ social science in analyzing Chinese copper mining in Africa, and we don't think the Human Rights Watch report authors did that. And social science has various tasks. First of all, of course, to add to our empirical knowledge about various social phenomena. Also to critique the so-called regime of truth, as Foucault used to say. That is, critique it empirically, methodologically, and politically, and change the world in some respect. So I'll talk now about this Human Rights Watch report. It, of course, concerns Zambia, which is located in sort of the southern central part of Africa. And the copper mines, not surprisingly, are located in the Copperbelt province of Zambia. So this is the cover of the report, entitled, "You'll be fired if you refuse." That is, if you refuse to do unsafe mining practices. If you're a mine worker, the Chinese will fire you. And Human Rights Watch represents itself as being, of course, a nonprofit, which it is, an NGO, dedicated to defending and protecting human rights around the world. And then it says that its reports are empirically accurate, methodologically sophisticated, and politically neutral. Well, as you will soon see, we think that this report, at least, was empirically inaccurate, methodologically awful, and politically neutral, not at all. So the first question that, or maybe the main question the Human Rights Watch wanted to pose was, what are the human rights implications of Chinese investment in Africa? Well, they're going to be talking about the human rights implications of Chinese investment in Africa, which involves over 2,000 companies, and they're going to be talking about it in terms of exactly one company in one country. But nevertheless, they didn't hesitate to generalize from that study about the practices of Chinese companies on the whole continent, and I'll come back to that in a few minutes. So the case that they selected were these 4 mining firms in Zambia. They're actually all owned by one company, CNMC, and these are the 4 mining companies, 2 mines and 2 smelters. There are, of course, other foreign investors in mining in Zambia. In fact, the vast bulk of mining in Zambia is done by foreign firms, 89% of Zambian copper production by foreign firms. And as you can see, the firms originate in various places. The largest one, Konkola Copper Mine, owned by Vedanta. Vedanta is a very famous Indian company, although it's headquartered in the UK, so more properly in terms of citizenship, it's a UK citizen. Although the Agarwal family owns the company, which is a family that's based partially in India and partially in Britain. Glencore, any of you who have any familiarity with trading of minerals know about Glencore. It notoriously owns the Mopani copper mine and notoriously pays very little taxes to Zambia. Canadian companies are quite prominent now. First Quantum Minerals, headquartered in Vancouver, owns the Kansanshi mine. This is the most profitable mine. I'll be coming to that in a minute too. Lumwana mine, at that time, was owned jointly by an Australian and a Canadian company. Later on, the Australian company decided to leave, and it's now owned by Barrick Gold, a major Canadian company. Meteorex, which was owned by a South African company, a white South African company, owned the Chibaluma mine. Since then was sold to Jinchuan, which is a major Chinese mining company. This is a fairly small mine, but very, very deep underground mine. So as you can see, foreign firms do most of the mining in Zambia. CNMC, the Chinese company, at that time, less than 5% of copper production in Zambia was attributable to that Chinese company. It's now up to about 6%. So in terms of methodology, how did Human Rights Watch report? How did the Human Rights Watch report come into being? It came into being by a recent graduate of Harvard Law School going to Zambia and interviewing some miners. So he interviewed some miners working for the Chinese-owned company and some miners working for the other foreign investors. So all of the information that he had, that he placed in this report, was based upon these interviews. Human Rights Watch approach to doing their reports is to rely upon only one method, and that's interviewing. So they don't gather statistical data, they don't do field site visits, etc. They just interview people and get their opinions. So these were the opinions of various miners who they were able to assemble and hold focus groups and interview them about their experiences of working either at a Chinese company or another foreign-owned company or at both. So the empirical argument made by Human Rights Watch was that CNMC, the Chinese-owned company, was the worst company in all respects in terms of its mining practices in Zambia. Worse on safety, worse on pay, worse on all aspects of safety, by the way. Pay, they claimed that actually mine workers working for the Chinese, as they always would put it, those mine workers were only earning 1/4 as much as the mine workers working for the other foreign mining companies in Zambia. They were, the Chinese company was accused of being the worst in terms of working hours and the worst in terms of union rights. And I'll be talking about that in a little bit of detail in a few minutes. So they had to, of course, explain why the Chinese company might be the worst. And they said that Chinese companies in general trivialize safety. They have no safety concerns. And in part, this is because they import their labor standards from their practices in China. As for the significance of the study, as I mentioned earlier, Human Rights Watch claimed that on the basis of the study of this one company, they could generalize about the practices of Chinese companies in Africa, not just in mining, but across the board. So they said that their case study would be a magnifying glass and it would begin to paint a picture of China's broader role in Africa. Well, we mounted a critique of this report almost as soon as we saw it because it struck us as being almost entirely wrong in terms of the so-called facts that it advanced and in terms of its methodology. First of all, we argued that basically this was a contribution. The report was a contribution to the Western discourse on China in Africa. And we have critiqued the general Western discourse about the Chinese presence in Africa in detail in other works that we did. And we think that the discourse, by and large, is highly distorted and very politically biased. Not only politically biased, but also racially biased. That is to say, a lot of what's said about Chinese practices in Africa resonates with long-standing Western stereotypes about what Chinese people are themselves like. And particularly the idea of Chinese cruelty and Chinese disregard for human life. This is a trope that was found extensively in anti-Chinese agitation in North America, in Australia, in South Africa, in Britain, and other parts of the world. And it hasn't by any means died. Also, we thought that there was a political background to all of this. That is, the Western media had focused a great deal of their attention on the Chinese presence in Zambia and made it into a major political issue. In part, it was a major political issue because Zambia was the one country in Africa where there was an anti-Chinese movement constructed based upon political opportunism on the part of the main opposition party in the country, which was the Patriotic Front, led by Michael Sata. And in other works that we've done, we've collected quotes from Sata. We interviewed Sata himself in Zambia while he was still an opposition politician. And he was virulently anti-Chinese. Any nasty thing you can think of to say about the Chinese, Sata said it. Sata basically constructed his campaigns for the presidency from 2006 to 2011 on an anti-Chinese platform. Again, this is the only country in Africa where this has taken place. There, of course, there are critiques of the Chinese presence in some other African countries, but nothing on the level that occurred in Zambia. And so the Western media focused a great deal of attention on the Chinese presence in Zambia. Everything they said about it was negative, and they especially focused on Chinese presence in copper mining in Zambia. So the overall effect of the issuance of this Human Rights Watch report was, first of all, to create a sensation in the Western media. There were literally thousands of news reports about the Human Rights Watch report. There were millions of documents circulated around on the internet that discussed the report. We try to mount a response, but well, Human Rights Watch is a major organization among NGOs in the world with hundreds of employees, and we were just two small fry Hong Kong academics trying to respond to it. But we did get some things published in Pambazuka News, which is one of the major collectors of various studies and polemics about Africa, based, I think, in Nairobi now. And we also published some things in Asia Pacific Journal, which, as the name implies, is all about Asia. So in that way, we got our critique circulated a bit. It also appeared in a few newspapers, particularly in Hong Kong. So we responded, and Human Rights Watch responded to our response. So we carried out a debate lasting over the course of some months in various media. In the end, Human Rights Watch refused to say that they had made any mistakes whatsoever. This is, if any of you are from the United States, you know this is a characteristic that is found among Americans. That is, to deny everything, never admit you've done anything wrong. And so that was the approach of Human Rights Watch. These are some workers coming out of a Chinese-owned mine in Zambia. So there were various issues at hand in the report. The most important one was safety. And as I said earlier, the way that Human Rights Watch approached this and other issues was just to ask people, do you feel unsafe? Well, any of you who have been involved in the mining industry know that mine workers often feel unsafe, no matter how safe the mines are that they work in, because mining is an inherently unsafe industry, or at least it presents dangers. So the mine workers that they interviewed would say, yeah, there are safety problems. But we said that this is not actually the proper approach if you're comparing safety at various mines. If you want to compare safety at various mines, you just don't ask people subjectively whether they feel safe or unsafe. Rather, what you do is you look at statistics, and you look particularly at the rate of deaths and serious injuries. These kind of statistics for mines in Zambia are not public information. So we had to go down to the mine safety department in Kitwe in the Copperbelt, hang around and do, as Chinese say, la guanxi, that is to establish connections with people working in the mine safety department, become their friends, and they're nice guys. Eventually, because they got to know us, they gave us the applicable statistics. And we were therefore able, over the course of many years, to show the rate of deaths and serious injuries in the various mines in Zambia. And we've compared the number of workers employed to the number of deaths and serious injuries. So for each one of the foreign-owned mines in Zambia. And we found from 2001 to 2008, because the Human Rights Watch report concentrated on this period, that the Chinese companies employed 7.2% of the mining workforce in copper mining in Zambia among the foreign-owned companies, and that they accounted for 8.2% of total fatalities. I should say that fatalities and serious injuries are very highly correlated in the mining industry. So if you know about the number of fatalities, the number of serious injuries has a very close relationship with that. As for minor injuries, nobody really keeps statistics about those because those are usually fudged anyway. If there's a minor injury, often it's not even recorded. So what really matters most is fatalities. So we found that, well, actually the Chinese companies' rate of fatalities is pretty much as we would expect it to be, given the number of workers that they had. There was a little bit of an uptick in terms of fatalities at the Chinese-owned companies after 2008, and that's because the Chinese companies were expanding while the other companies were contracting as a result of the global financial crisis. So here's the chart showing fatalities at the Chinese-owned companies, fatalities in total in the Zambian copper mining industry by year. Also, we thought there was another important methodological consideration, which was that when Human Rights Watch went out to interview mine workers, they only interviewed those mine workers who had a permanent job at the mines. Now, those of you in the mining industry know that in many mines, particularly in the developing countries, there are permanent workers, but there also are a lot of contract workers. The contract workers generally are given the most dirty and dangerous jobs. They get much lower pay, etc. So, Human Rights Watch, for reasons unknown to us, although we have our suspicions, they decided to only interview the permanent workers of the companies that were owned by non-Chinese foreign investors. Yet, at these companies, as you'll see in a minute, there are a very high percentage of contract workers, and those contract workers work in much less safe conditions than the permanent workers do. The Chinese companies have no contract workers. They're all permanent workers.
Sorry, I was just about to ask if that was different between the...
It is, and I'll show you a chart in just a minute. So, this is what Human Rights Watch said about the interviewing that they did, the kind of workers that they interviewed. Also, we think there's another consideration that comes into play. These interviews were conducted in the run-up to the 2011 election in Zambia. This was an election where the opposition party, the Patriotic Front, was berating the Chinese on a daily basis. Their main area of support was in the Copperbelt, and their biggest area of support in the Copperbelt was among copper miners. So the copper miners were on a daily basis hearing how bad the Chinese are. And we think that it is therefore suspicious to interview workers who were overwhelmingly supporters of Michael Sata and the Patriotic Front, who were constantly framing Chinese in a negative way in order to attain political power, and to consider those testimonies by the workers about Chinese mines versus mines owned by white people to consider whether those are unbiased testimonies or not. And in fact, studies by psychologists and by historians have shown that where people have racial prejudice, they can't say anything accurately about the subjects they're asked about. They're so distorted in terms of their view by racism that they can't accurately attest to even very elementary things, even things within their own daily experience. This is the late Michael Sata. He died in late 2014, so no longer president of Zambia. These are some slogans written on the wall during the wave of strikes which occurred right after Sata attained power in 2011. I think all the copper mining companies in Zambia experienced strikes then, workers demanding higher pay. Of course, in the case of the Chinese-owned mine, put in racial terms. China must go, Chinese are not to be admitted inside, etc. Then there is a question with regard to safety about the difference in terms of the level of safety at underground mines compared to surface mines. Now again, those of you who've been in the mining industry know that there's a huge difference in the level of danger in underground mines compared to surface mines. In underground mines, you have rock falls, the ceiling collapses, you have rock bursts, etc. In surface mines, open pit mines, nothing like that. Not to say that there aren't casualties in surface mines, but they're nowhere near on the level of underground mines. Studies in the US show that the rates of deaths in underground mines compared to surface mines 3 times as high. I saw a study from Australia indicating that the rate of death in underground mines was 7 to 8 times as high as surface mines. I don't know how to account for the difference. Somebody who's a mine safety specialist could enlighten me perhaps in that, and just why there should be such a big difference from the US to Australia.
Coal, underground coal, you've got gas exposure as well, and explosion, which will add to that.
I see. Right. In any case, Human Rights Watch didn't take that into account at all. That is, all the two Chinese-owned mines were both underground mines, and fairly deep underground mines. And as you know, the deeper you go, the greater the danger. The other foreign-owned mining companies all had only surface mines, or they had mostly surface mines and a little bit of underground mining. So that means that if the rate of casualties at the Chinese-owned mines are roughly the same as the rate of casualties at the other foreign-owned mines, the Chinese mines, being underground mines, are actually safer. I'm not safer in the absolute sense, but safer in terms of what you would expect in terms of safety practices. That is, they have managed to raise the level of casualties for underground mines to the same level, basically, as the level for surface mines. Also, in terms of comparing safety, another methodological problem, you have to look at the workforce. A well-trained, highly skilled workforce is going to be safer because they know what they're doing than a relatively unskilled workforce. Because the Chinese mines were mines that had been closed for significant periods of time under European ownership, that is, European owners came and went, and there also were some Indian owners came and went, and so the mines were open for a period of time, then closed. Chambishi mine, as I mentioned, was closed for 13 years. That meant that there were huge gaps in terms of the experience on the part of the workforce employed once the Chinese came and bought those mines. They had to get a lot of very inexperienced workers and work in their mine compared to the much more experienced workers working in the mines owned by other foreign investors. So needless to say, if you have less experienced workers, they're going to make more mistakes. And if they make more mistakes, that's going to create more casualties. But that wasn't taken into account at all by the Human Rights Watch investigators. So, in our conclusion, we argued that, contrary to the claims being made by Human Rights Watch, the overall fatality rate of CNMC wasn't markedly worse than the other firms. There were some problems in terms of personal protective equipment, in terms of the authority given to safety officers, in terms of reporting of injuries. These were real problems, but they hardly rose to the level of human rights violations as we commonly think of them. And actually most of these problems were subsequently settled. Because there are vigorous unions in the mines in Zambia, and those unions certainly were concerned about safety problems. So another of the aspects of the report had to do with wages, because as I mentioned before, there was a claim by Human Rights Watch that the workers at the other firms, the non-Chinese owned firms, were being paid much less than the workers, are being paid much more than the workers at the Chinese owned firms. And we of course were able to access the contracts that the unions had with the mine owners. We did this because we have good ties with the two major mine workers unions in Zambia, and they were able to provide us with all the contract information. We actually were able to also establish contacts at the Department of Mines, and they confirmed the contracts that were shown to us by the unions. So we were able to figure out how much the workers were being paid at the various companies, mining companies in Zambia. And our calculation then was that compared to the very best paid miners who worked for the largest mine, KCM, the one that I mentioned was owned by the Agarwal family, the level of pay at the Chinese-owned mines was anywhere between 50 to 80%, depending upon which one of the four enterprises one was talking about. But that was just a comparison between the permanent workers at the Chinese facilities to the permanent workers at the other foreign investors. But permanent workers represent not a majority at most of the other foreign investors. Rather, it's contract workers. And contract workers are the ones who are actually paid 1/4 to 1/2 of what the permanent workers receive. So the CNMC mines, no contract workers at all. But at the two other major foreign-owned mines, 50% of the workforce would be contract workers. So if you compare the total workforce at the other foreign invested companies to the Chinese companies, then the pay gap narrows very considerably. So this chart shows the number of permanent workers and contract workers, the percentages also at the various companies. So these are the major non-Chinese foreign investing companies. So ranging from a low of 26% at the smallest mine to up to 57% at the Australian-owned mine, KCM 5450, etc.